why would Powell be talking about returning to those very policies that created the problem that the Fed is now struggling with? Because Powell cannot be honest with the markets. Because if Powell actually told the markets the truth that high interest rates are here to stay, the markets would crash.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
I'm talking about why the Fed is trying to let the markets know that these high interest rates are not here to stay. That before long, by next year, the Fed's going to be cutting rates and moving back to a stimulative monetary policy. And I think that is the main reason that you've seen the strength in the stock market, because investors are looking forward to a new round of stimulus where we have a Fed funds rate that is low and potentially a return to quantitative easing. And I think the reason for that is because the Fed understands the problem of keeping interest rates where they are for any extended period of time. But the reality is, in order to get inflation down to 2%, not only is the Fed going to have to keep interest rates where they are for many, many years, it's actually going to have to provide additional hikes beyond the 25 basis points that it is forecasting, maybe for the September meeting or another meeting later this year, because what the Fed has already done is inadequate for the job. Because if inflation really bottoms out at around 3% headline, and if the core really bottoms out at around 4.5%, 5%, and the Fed's already up at 5.25%, 5.5%, clearly it needs much bigger rate hikes to get the job done, especially if the headline number 3% by the end of the year is back up to 5% or higher. It means that all of this rate hikes and inflation continues to, be well north of 2%, which means there's a lot more that has to come, but the markets will not be able to bear it. For example, the last time we had a Fed funds rate where it is right now was 23 years ago. You got to go back to the year 2000 to find a Fed funds rate at this level. But to put this in perspective, and I'm just going to look at the federal government, because everybody's got more debt now than we had in 2000. It's not just the government. Thanks to these low interest rates, the corporate sector, households, everybody has a lot more debt than they had in 2000. But I looked up the national debt in the year 2000, and it was $5.6 trillion. Today, it's $32.7 trillion. That is a huge difference. Now, what I want to do for comparison is look at what it would cost the government to finance the $5.6 trillion debt at interest rates of 5.25%, because that is the prevailing market rate. Now, the government doesn't have to finance the entire debt at the market rate, because some of that debt is longer term and has been locked up. But it's always important to try to assume what it would cost to pay the current debt at current rates, especially now, given how short the maturities are of the national debt, because every year, maybe a third of the national debt comes due. And so all of that debt, which is financed at 10, 25 basis points, matures, and it has to be rolled over at 500 basis points. The only way they can get it down to 400 basis points is if they borrow, 10-year treasuries, something like that. But they're trying to keep the maturity short. So it's very important to look at what it would cost to finance the national debt at the current rate of interest. So back in the year 2000, at 5.25%, given the size of the national debt, it would have cost the U.S. government $300 billion a year to pay the interest on the debt. Now, to put that number in perspective, the defense budget in 2000 was $400 billion. So interest on the debt at the market rate would have been about 75% of what the government spent on national defense. Now, compare that to today, where we have a $32.7 trillion national debt. If the government had to pay a market rate of interest on that debt, that's $1.8 trillion a year in interest. That is an enormous number. The amount of money spent on defense in 2023, the entire defense budget is $840 billion. So it's more than double what it was in 2000, but interest on the debt is about 6 times what it was in 2000. So today, it would cost more than twice as much as we pay for defense to finance the national debt at the current rate of interest. And the problem is that over the next, let's say, 2, 3, 4 years, the national debt is going to explode from 32.7 trillion to closer to 40 trillion. So it's going to be a much bigger number, because over those years, more and more of that low yielding debt is going to mature and have to be refinanced at the market rate, which is currently 5.25%, 5.5%, but which could be quite a bit higher than that. Now, this is impossible. There is no way the government can pay 1.8 trillion a year in interest, let alone 2 or 3 trillion, which is what it would pay if the Fed left interest rates at this level for a long enough period of time. So it's got to tell the markets that rates are coming down. It's got to give the markets that false sense of confidence not to have to worry that today's high interest rates are here to stay. Well, they are here to stay. In fact, they're going to get even higher because inflation is not going away. The Fed is still pretending that what it's done is enough to bring inflation back down to 2% to the extent that they can already start cutting rates next year. Even though inflation is nowhere near 2%, the Fed is telling the markets, don't worry, we're cutting rates next year. Now, another reason that this is important is mortgages, the housing market. Right now, the 30-year fixed rate mortgage is 6.8% is where they averaged, I think, at the end of the week. Just a little bit under 7%. But if you look at what's happening in the bond market is getting clobbered right now. The bond market, almost all the maturities now are back above 4% on the shorter end. But the bond market, to me, if you look at that chart, the bonds look like they're about to get hit. And I think we're going to see an 8% fixed rate mortgage by the end of this year, which isn't that big a move from 6.8%. 8%. You know, by the way, we finally broke a winning streak. We had a 13-day winning streak in the Dow. The last time we had a 13-day winning streak on the Dow was 1987. Now, that year didn't end very well because we had the stock market crash in October. The 14th day was a down day for the Dow, so we didn't hit a 14th day in a row. That would have been a record which went back, 100 years or so, or I forget how long it would have been. But in 1987, the stock market was rising against the backdrop of very bad economic news, rising interest rates, rising trade deficits, rising budget deficits. Same thing we have now. I mean, the markets ignore all these bad news until all of a sudden it can't ignore it anymore. And I think that's what's going to happen because the bond market is really getting clobbered. But the point I'm trying to make here about real estate, if mortgage rates get to 8%, the last time mortgages were at 8% was also in the year 2000. So the last time we had a Fed funds rate where it is today, we had 8% mortgages. And so I think that we're going to get 8% mortgages again this year. Same thing with the commercial real estate market, the junk bond market. There are all sorts of notes, debt instruments that were taken out when rates were really low that are going to be maturing next year, the year after that. And the Fed has to hold out some hope, right? Let the markets believe that there's going to be some relief coming, like the cavalry is coming to the rescue and rates are going to be able to come down. But what? How could that possibly be when inflation is still as high as it is? There is no justification for lower interest rates. Yet Powell wants to pretend that we are going to be returning to a low interest rate environment. Well, how is that possible? Because we're not going to return to a low inflation environment. And if we're not going to return to a low inflation environment, we're not going to return to a low interest rate environment. In fact, last week, we got the news that the Teamsters had reached an agreement with UPS for substantial wage hikes over the next 5 years. I'm not sure the full-time. I didn't see the exact number for them, but I saw the part-time workers, part-time drivers for UPS, and they're basically getting a 10% raise per year. It was 9 point something, but rounds it up to 10%. 10% per year for the next 5 years. 10% increases. What does that tell you? I mean, it's not that these wage hikes are going to cause the inflation. The point is the inflation has resulted in these wage hikes. Again, you know, during the Q&A portion of the press conference, a lot of the reporters asked Powell about if he was worried that rising wages would be a problem for inflation and wage inflation, or would rising food prices be a problem creating inflation. And all these questions are being asked by people who don't understand inflation, and they're being asked of a Fed chairman who doesn't understand inflation, because inflation is not caused by wages going up. Inflation is not caused by food prices going up. It's inflation that causes wages to rise. It's inflation that causes food prices to rise. That's what's going on. Now, food prices could rise for other reasons other than inflation, but if food prices rise, absent inflation, the price of something else is going to go down. So rising prices won't cause inflation. It's inflation that causes all prices to rise, and that's what's happening. But you can't overlook what's going on. These 10% per year increase in wages for UPS, what is this telling you? This is telling you that shipping costs are going to go way up. Not just the wage component, but a lot of other factors. And if UPS is giving its drivers these big hikes, FedEx is going to do the same thing. The cost of shipping everything is going to go way up. Well, what are these companies going to do? If companies are having to pay higher prices to ship their products, well, what are they going to do? They're going to pass that on to their customers. All this stuff is going to be passed on. And of course, the individual consumer, when they finally get their products, they're going to pay another shipping cost, right, to get it to themselves. So there are tremendous inflation pressures that are building. You can see it, right? You can see the impact inflation is having on wages, on other costs. And the Fed is oblivious. Yes, Powell is saying we still see inflation as a threat, but at the same time, he's promising to cut rates next year in the face of that threat, saying that we don't want to be optimistic. In fact, somebody asked him, if, he's optimistic. And Powell said, well, I wouldn't want to say I'm optimistic. Let's just say I see a pathway, meaning getting to 2% inflation. Well, I mean, he's obviously optimistic if he's forecasting rate cuts next year, and then he's admitting that the Fed's going to start cutting rates long before. He said long before we get to 2%, not just before 2%. He said long before we get to 2%, we're going to start cutting rates. Why? Why don't you wait till we get 2%? In fact, he should wait for under 2% to really make sure that we get down there. Because if he just wants to assume that 2.5% is going to become 2%, and so he just starts cutting interest rates, on the come, because he just believes that the 2.5% inflation is going to go down to 2%. And what if all of a sudden it goes the other way? right? What if the fire is starting to, go out, and then he throws gasoline on it and it ignites all over again? It makes no sense for a Fed chairman who really is concerned about inflation to be talking about cutting rates next year. What Powell should be saying is there are no rate cuts anywhere in sight. Maybe we're going to stop hiking at 5.5, but rates are going to have to be at 5.5 indefinitely. After all, this is where rates were, 20 years ago, 25, 30 years ago. This was normal. A 5%, 5.25%, 5.5% Fed funds rate is not low. Historically, if you go back ever since we've been off the gold standard, but certainly if you go back to the 1970s, 1980s, 1990s, the rate we have right now is not high. It's kind of average to low. So why would Powell be promising a return to the very artificially low interest rates that caused all this inflation in the first place? The reason inflation broke out to the highest level since the 1970s is because we kept interest rates so low for so long. Why would Powell be talking about returning to those very policies that created the problem that the Fed is now struggling with? Because Powell cannot be honest with the markets. Because if Powell actually told the markets the truth that high interest rates are here to stay, the markets would crash. There's no doubt in my mind that that's what would happen. And the reason the markets haven't crashed is because Powell continues to suggest, not only suggest, to say, to reassure the markets that it doesn't matter whether we hike rates again in September, because by next year we're cutting rates. So don't worry. This is all temporary. The pain is going to go away. We've got relief coming. Well, the pain's not going to go away. The pain is actually going to get worse.